Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. It is Tuesday, the 13th of March, 2007, and the market's closed. We had a pretty good little sell-off here today. The Nasdaq 100 on the screen right now lost just about 2%, 1.94%. They were down 84 cents. And yesterday I was thinking maybe it looked a little bit too obvious that we might see a rally up towards that 20 and 50-day moving average, but no, the sellers took control, and we saw it break down very nicely. So once the market got below that $43 level right in here, this is where the real selling began. And then I posted midday that things could get really ugly into the afternoon here if this support level had been broken near 42.65 or 42.60. And that's exactly what we had happen, is that the lows of the last week or so were broken. We did have what looked to be a range-bound market. I was pointing yesterday this rising 5-day moving average, but you can see how that quickly started getting dragged down by the market as well. And the bigger picture always is what you should be focused on. When you're unsure of the intermediate term moves, what you have to do is look to the next further level back. And you can see now clearly that that support did become resistance. It, of course, always has the potential to do so, but it won't always do it. We saw a low volume rally, which I'd been pointing out, up to that level of resistance. And then today, the selling resumed and the fear came back into the market. That's why we saw that big volume return once again. So I think that it's inevitable that we're probably going to test this 200-day moving average sometime in the next week or so. That's down near about 41.30. And that's also close to the measured move target, which if you take the height of this move and subtract it from the high here, brings us down to about $40.85. So I think maybe 40.80 to 41.15 is somewhere where we settle down for this leg lower. But it's clear to me that the sellers are definitely in control of this market, and it became very convincing once it broke below this level. We could also look in here and say, well, maybe this is a head and shoulder top, whatever you want to call it. If so, then we could take the height of this, 43.30, let's just call it, down to 42.60. That's 70 cents, and that would give us a 41.90. And I think that, you know, shorter term, that 41.90 could be a level where we find a little bit of support. Probably, you know, even tomorrow, maybe we just take out these lows a little bit, then start to stabilize, unless we just have a meltdown. The fact is, though, we are now officially, in my mind, the way I look at the markets, we're in a bear market. We've got lower highs, and in particular, if we take out this low, we get another lower low. But we've got the 10-day moving average below the 20-day moving average, which is below the 50-day moving average, and they're all declining. So the only way to objectively look at the market, based on the way I look at it, is that this market's in a downtrend. It's guilty till proven innocent. Long trades are riskier in here, and you got to just be very careful if you're going to be trading long. There's obviously always going to be some kind of stock that's moving higher, but finding them and finding the follow-through on them, it gets a lot more difficult. Odds are on the short side. Now, short sales are obviously something you can definitely make money on. If you're in a retirement account, qualified money, like you want to take a look at these inverse funds. What a great vehicle for the next bear market is you're going to see volume surge in these things like we saw today here in the QID. Now this is the one that I've been talking about, that this breakout past resistance looked like it was becoming support. Classic low volume pullback to that level. And the levels we were looking at were, if it was to break below 54.85, I thought maybe that this market would continue lower. But the level I've been pointing out on the long side is 56.50. And once it broke past these highs of the last few days, that's where the buyers took control. And it's basically a double inverse of the QQQ here, like we see here. So that 56.50 level is equivalent, basically, upside down to this 42.65 level that we saw break in the Qs. On the Qs, we were looking for maybe a rally above this level. That never occurred. So we always want to be aware of all possibilities. And looking at the spiders, same thing here. Just an ugly-looking market. Seeing this downside shouldn't come as a surprise to anyone. It is, as I say, guilty till proven innocent when we've got all these moving averages heading lower and the market below them. The 10 below the 20, the 20 below the 50, the direction of those moving averages is all heading lower. We saw the low volume rally in there too, and this big return of volume means there's more fear coming into this market, It looks like probably we're in for a test of the 200-day moving average at a minimum here as well. Doesn't mean that it's going to stop there. It means that it's likely, though, that we'll find at least a bounce or support in that level for a little while before the next leg lower. And how low this market goes is anyone's guess. How long it takes is anyone's guess. But the fact is, it's in a downtrend. Therefore, it's guilty till proven innocent. It doesn't matter if it looks too obvious sometimes. Sometimes the obvious is right. You know, I quoted Joe Granville yesterday saying, "What's obvious is obviously wrong." Well, not this time. We were looking at the possibility of a short squeeze rally above this 141.35 yesterday. That didn't occur. We saw the gap. It came down that 5-day moving average, and then it failed just absolutely beautifully if you're short, or miserably if you're long. But we're looking at 140 basically. $140 is saying this is the level that if it breaks down, time to get extremely defensive. Defense wins the game here, and that would have, you know, just in there, that was good for nearly 2 points on the short side. If you'd just gotten out of any long positions, then that would be, you know, worth it as well. But let's just examine in here again. Look at these moving averages, and this is how I use them. When we see the moving averages crisscross at the end of a decline, it means there's indecision, which typically means accumulation for the next rally. When we have the short term above the intermediate, above the long term, and they're all advancing, then we're in a short-term uptrend. When we see those moving averages crisscross again, it means there's indecision, which typically will revert back to the bigger picture and continue whatever trend we saw there. So when it broke down below this 140.10 level, that's where it officially became a short-term bear market as well. So that's how you want to look at these things. And now you look at them, the short-term, intermediate, and longer-term moving averages are all heading lower. So stay away from the long side. Maybe if you're a scalper, you go in there and try and pick off one of these little rallies in here. But you know, the sum of the rallies is always less than the sum of the declines in a bear market. That's the definition of a downtrend: lower highs and lower lows. It drops 2 points, it rallies 30 cents. It drops 50 cents, 60 cents, it rallies 40 cents. The odds just aren't there. Make your job easier and go with the trend.